Okay, hello guys. Welcome back to our YouTube channel. So today we're going to be having a video session where we talk about some very important aspects of law and how it relates to your business and your daily life. So today we're going to be talking about how businesses can raise capital, how businesses can raise funds for their business. Because truth is, amongst all the factors of production, capital is a very key factor because without capital, without money, you can't run your business. Money rules the world, really. If you want to expand production, you want to expand your market base, you need money. If you want to penetrate into new markets, you need money. So startups often find themselves in this dilemma of how do I raise funds? How do I get monies to fund this project, to run this business, and to make it a success? So today we're going to be looking at the ways to raise monies, to raise capital. Now we're going to consider two ways. Of course, you already know that you can borrow monies from family members, from friends, well wishers, those who really want to see you succeed. They can say, okay, you know what, take this funds, use it to start up. Let's say you just finished from school, you want to start up something, let's say a tech startup, and then you have a wealthy father. Your father can advance you some capital. So that's grand. Your father is more like an angel. He's investing in your business. Sometimes he may not really need a payback. Okay, just gives it to you as a gift to his son. Family members, friends can also do that. All right, and some people you just get to know from anywhere. They can also advance credits to you, not necessarily as loans, just to give it to you to run your business. All right. So, but what we're going to be focusing on, um, we're going to look at the two major ways to raise funds to expand your business. All right, to raise capital for your business. So, one, we have the debt financing. Two, we have the equity financing. So, I'm going to start with the debt financing. As the word implies, debt. That means you're indebted. You're borrowing. All right. So that's a simple word. You're borrowing. So when you borrow money, you are expected to return the money and return it with interest. So if you have a business and you want to um you want to get monies for the business, one of the things you can do is to approach a bank or approach individuals, and then they will give you money, tell you pay within such and such a time, and pay with interest. So that's one of the major ways that you can approach banks, microfinance banks, and any other financial institution that can advance you with capital. The important thing to note in this method is that the individuals giving you monies are not going to be co-owners of your business. They cannot necessarily tell you how you run your business. Okay, all they're concerned about is I have given you money, I need the money back with interest. Of course, they will want to see to the success of your business because they also understand that if you're not doing well in your business, you will find it difficult to pay them back. So that's one of the ways to raise capital by debt financing. You give out, you borrow money from people and then you pay back in the form of principal and interest. Another very important one, which is the next one, is equity financing. So you're opening your business in this case, you're telling people invest in my business and become a part owner. So let's say, for example, you started a business alone under the newcomer. You can just have a shareholder. All right. So you started your business alone as a singular owner of your business, a limited liability company, for example, and you're looking for money. You approach someone, the person tells you, okay, you know what? I think I see hope of a future in this business. Make me a part owner of this business and I'll give you 100 million. So that 100 million is now valued. You can now say, okay, 100 million goes for 30% of the shareholding. So you can hold 70, right? And then the person who is giving you money, who is coming into the business, holds 30. So first you have to value your shares. Most times when a company is starting up, they don't have lots of the value is not very high. All right. So you see people selling maybe 50% of their shareholding for 500,000 naira. But if the company has grown to a profitable extent or level, you can sell 5% of your company for as much as maybe 1 billion. It depends on how big the company is. So before you give out equity, you have to value the shares and value the company. And valuing the company also includes valuing the goodwill, the name of the company. I mean, it takes a whole lot. So if you can't find someone that will borrow you money in return for interest, you can find someone that will invest in your company and become a part owner of that company. So we call it equity financing. So the person gives you money and takes shares. When he takes shares, he's not going to get the money back. So in other words, he's not giving you the money with the expectation that you pay him back. He's giving you the money on the understanding that he's ready to take a risk with you in the business. And if the business succeeds, both of you share the profit. If the business fails, you share the loss. His money is gone. All right. So you're only going to the person who will invest in equity in your company is only